Welcome back to AgJohn Silver Update. Something extraordinary just happened in the silver market, and almost nobody is talking about what it really means. Shanghai didn't simply see silver prices rise. The pressure became so intense that the Shanghai Futures Exchange was forced to step in with emergency measures. This wasn't caused by a computer failure or scheduled maintenance. The exchange reacted because silver premiums exploded far beyond normal levels, creating conditions that threatened the stability of trading itself. If you've followed silver for any length of time, you already know that silver in China usually trades at a small premium compared with London or New York. That's completely normal. Import taxes, transportation costs, and local supply conditions have always created a modest difference. But what happened this time was something entirely different. Instead of the usual few percent premium, prices in Shanghai suddenly surged into territory that experienced traders rarely see. Physical silver became dramatically more expensive than the international spot price, and the gap kept widening instead of shrinking. As physical prices raced higher on the Shanghai Gold Exchange, futures traders rushed into the market, pushing silver contracts sharply upward on the Shanghai Futures Exchange. Prices repeatedly reached their daily trading limits. Trading became increasingly unstable, forcing the exchange to tighten restrictions, raise margin requirements, and limit activity across several contracts. In practical terms, normal trading was no longer possible. That alone should tell you this is much bigger than a local market story. What happens inside Shanghai doesn't stay inside Shanghai. China has become one of the most important drivers of physical silver demand in the world. When buyers there are willing to pay significantly more than everyone else, it changes the direction of global silver flows. It influences London, COMEX, refiners, miners, and eventually the silver price you see every single day. So before anyone jumps to sensational conclusions, let's understand exactly what happened. China operates two major silver exchanges. The Shanghai Gold Exchange focuses on physical silver, where actual metal changes hands between buyers and sellers. The Shanghai Futures Exchange handles futures contracts, functioning similarly to COMEX by allowing traders to speculate or hedge using paper contracts. Under normal conditions, both exchanges stay relatively close to international prices, with only a small premium reflecting China's import system and logistics. For years, this relationship remained stable. This time it didn't. Within a very short period, physical silver prices in Shanghai accelerated far faster than prices in London or New York. Reports from market participants showed premiums climbing into double-digit percentages above the international spot market. That immediately created enormous arbitrage opportunities. But unlike stocks or currencies, physical silver can't simply be transferred with the click of a button. Metal has to be refined, transported, insured, pass customs inspections, and move through China's controlled import system. Even when price differences become extremely attractive, the supply chain simply cannot react overnight. That delay became the fuel that allowed premiums to climb even higher. As traders watched physical prices continue rising, speculation intensified. More investors entered silver futures expecting the shortage to continue. Open interest expanded rapidly, daily price limits were repeatedly tested, and volatility exploded. The Shanghai Futures Exchange responded exactly as exchanges are designed to respond during periods of excessive risk. Margin requirements were increased, forcing traders to commit significantly more capital. Daily price limits were adjusted, certain trading activities became restricted, and pressure was placed on highly leveraged positions. This wasn't a random interruption. It was a clear signal that the market had moved so aggressively, so quickly, that the exchange itself believed intervention was necessary to maintain orderly trading. And that raises the most important question of all. What could possibly create enough demand for physical silver that one of the world's largest commodity exchanges decides the market is becoming too hot to handle? Because once we answer that question, the entire global silver picture starts looking very different. The answer begins with one word: demand. China isn't just another participant in the silver market. It is the world's largest industrial consumer of silver, and that makes every change inside its economy incredibly important. The country manufactures more solar panels than anyone else, produces massive amounts of electronics, dominates electric vehicle production, and continues expanding its 5G infrastructure. Every one of these industries depends on silver. Take solar energy alone. Each individual panel only requires a relatively small amount of silver, but when you're producing hundreds of millions of panels every year, those small amounts quickly become an enormous demand for physical metal. Over the past year, China's renewable energy expansion has moved even faster than many analysts expected. New installations have accelerated, manufacturing capacity continues growing, and that has dramatically increased the need for silver. Now add the rest of China's industrial economy. Silver is essential for semiconductors, consumer electronics, batteries, electrical connections, medical technology, and countless high-tech applications. These industries were already consuming huge quantities of silver, but together they've pushed demand even higher while supply has struggled to keep up. Industrial demand, however, is only half the story. Investment demand inside China has also changed significantly. For decades, real estate was considered one of the safest ways for Chinese households to build wealth. But after years of declining property prices, struggling developers, and weaker confidence in the housing market, many investors have started looking elsewhere to protect their savings. Gold has naturally attracted enormous attention, but silver offers something different. It gives smaller investors access to precious metals at a much lower price per ounce, making it an attractive alternative. Banks, authorized dealers, and precious metals exchanges have all reported stronger interest in silver buying as more investors diversify away from property. Now imagine both forces happening simultaneously. Factories need more silver to keep production running. Investors are buying more silver to preserve wealth. Both groups are competing for the very same physical supply. That's exactly where the real problem begins. Although China ranks among the world's leading silver producers, its domestic mining industry simply cannot satisfy current demand. The country still relies heavily on imported silver to close the gap between what it produces and what its industries consume. And importing silver into China isn't as simple as placing an order. Only a limited number of licensed financial institutions are authorized to bring large amounts of silver into the country. Those imports move through quotas, customs procedures, transportation networks, and regulatory approvals. It's a controlled pipeline, not an unlimited flow of metal. When demand suddenly jumps beyond what that pipeline can deliver, prices inside China naturally rise faster than prices elsewhere. That premium isn't random. It's the market sending a clear message. There isn't enough silver available here right now. The higher that premium climbs, the louder that message becomes. It also sends a powerful signal to the rest of the world. Refiners, miners, wholesalers, and exporters immediately notice when China is willing to pay substantially more than London or New York. Economics always follows the highest bidder. Physical silver begins moving toward the market offering the best return. But here's the critical point. Silver doesn't travel overnight. Bars must be refined to the correct specifications, shipped across oceans, cleared through customs, and delivered to approved vaults. Those logistics take time. That delay allows shortages to become even more visible. It also explains why Shanghai's premium continued climbing instead of immediately correcting itself. This is exactly why the Shanghai Futures Exchange eventually stepped in. Most people imagine a trading halt as someone pressing a giant red emergency button where everything suddenly freezes. That's not how this works. Instead, the exchange gradually tightens the rules. Price limits are expanded to reduce violent swings. Margin requirements are increased so traders must commit more cash. Highly leveraged positions become more expensive to maintain. In some contract months, new positions are restricted altogether. The goal isn't to control silver's price. The goal is to stop excessive speculation from overwhelming the financial system. But here's what should capture your attention. Emergency measures can remove speculative traders. They cannot create more physical silver. And if the underlying shortage remains, the pressure doesn't disappear. It simply waits for the next opportunity to build all over again. Now let's look at why this matters far beyond China. The global silver market isn't made up of separate, isolated regions. It's one connected system. When one major buyer suddenly starts paying 10% or even 15% more than everyone else, physical silver naturally begins flowing toward that market. Think about it from the perspective of a refiner or mining company. If Shanghai is offering substantially higher prices than London or New York, where would you choose to sell your silver? The answer is obvious. Metal moves to the highest bidder. That shift doesn't happen instantly, but the decision happens immediately. Refiners begin directing future shipments toward Asia, exporters prioritize Chinese buyers, and global supply slowly starts moving east. As more silver leaves Western markets, inventories begin tightening. London, which serves as one of the world's largest physical trading hubs, has already experienced declining silver inventories over recent years. COMEX vaults have also remained under close observation as registered stocks stay relatively tight compared to the enormous volume of futures contracts traded every day. Futures exchanges have always operated with far more paper silver than physical silver available for delivery. That's normal. Most contracts are settled before delivery ever occurs. But when physical demand continues increasing while inventories become thinner, the margin for error becomes much smaller. That's exactly why events like the Shanghai Premium Explosion deserve attention. They're showing us what's happening in the real physical market, not just on trading screens. Another important piece of this puzzle comes from the long-term supply picture. For several consecutive years, global silver demand has exceeded total mine production and recycling. In other words, the world has been consuming more silver than it's producing. The difference has been covered by drawing down existing inventories. That strategy can work for a while. But inventories aren't unlimited. Eventually, more of the remaining silver becomes locked inside industrial products, investment holdings, ETFs, or private vaults where owners have little interest in selling. At the same time, increasing silver production isn't easy. Most silver isn't mined from dedicated silver mines. Roughly 70% comes as a byproduct of copper, lead, zinc, and gold mining. That means silver production depends heavily on decisions made in completely different mining industries. Even if silver prices rise sharply, bringing new production online often takes many years because of permitting, financing, exploration, and mine development. Meanwhile, demand continues growing. Solar energy requires more silver. Electric vehicles require more silver. Power grids, electronics, artificial intelligence infrastructure, medical technology, and advanced manufacturing all continue increasing their consumption of this metal. Those aren't temporary trends. They're structural changes taking place across the global economy. There's also another question worth considering. China has publicly reported increasing its official gold reserves over recent years. But unlike gold, there is no requirement for countries to disclose strategic silver holdings. Could China also be quietly building larger silver reserves? No one outside the country's leadership can answer that with certainty. But when imports remain exceptionally strong while domestic premiums continue climbing despite those imports, it's reasonable to wonder whether some of that metal is being stored for long-term strategic purposes rather than immediate industrial use. Whether that's happening or not, one fact remains undeniable. China continues pulling enormous quantities of physical silver into its economy, and every ounce that enters long-term storage or is consumed by industry is one less ounce available elsewhere. None of this guarantees that silver prices will suddenly explode tomorrow. Markets rarely move in straight lines. Corrections happen. Volatility is normal. Exchange interventions can temporarily cool speculation, but they cannot permanently solve a physical imbalance if demand continues exceeding available supply. That's the real takeaway from everything we've discussed. The Shanghai Futures Exchange didn't intervene because of a minor price fluctuation. It acted because the pace of buying became strong enough to threaten normal market operations. When you combine rising industrial demand, increasing investment buying, tightening global inventories, persistent supply deficits, and now unprecedented premiums in one of the world's largest silver markets, the evidence begins pointing in the same direction. No single indicator tells the whole story, but when multiple indicators all reinforce each other, they become much harder to ignore. That's why this event deserves attention. It isn't simply another headline from overseas. It may be one of the clearest signals yet that the physical silver market is becoming increasingly tight beneath the surface. The paper market can influence prices for a period of time, but eventually, real supply and real demand always have the final word. And that's exactly why we'll continue watching every development right here on Ag John Silver Update.